Well, we are going to see parity. We're going to get below parity, in my view. The euro system has spent the last 20 years muddling through. The question is, can it muddle through another crisis? And I think the answer is pretty much no. I think you made the wrong judgment in buying your euros too early. I think just sit back and wait. The reality is that they're trying to stop fragmentation in the eurozone, which means spreads deviating seriously away from, let's say, Bund yields. So the Italian bond trading significantly above in yield terms the Bund. That's, I think, going to be unlikely to achieve, given the fact that we're in now an inflationary environment. If you've said that eurozone inflation is going to be near double figures, 2 years ago, people would have thought you're from Mars, but we're getting pretty close to that. The numbers that came out yesterday from the PMI data shows that were very disappointing. They pretty much show that Europe is touching recession. And I think that what we're looking at worldwide is basically recessionary conditions. Asia's already there, Europe's touching it, America's probably a month away. And in that sort of environment, people are going to want safe assets. The question is, we're running out of safe assets fast. The Japanese yen, which was traditionally a safe asset, is weakening rapidly before our eyes. The dollar is the only safe asset left. And the eurozone, the euro is highly questionable. And I think, as these pins get knocked over, people are going to move more and more back towards the US dollar. That is the safe haven. The policy this year of the US administration has been a very simple one. Get the balance sheet down and get the dollar up. They've succeeded. We're heading for a recession. And the euro is going to get under huge pressure. Just look at the Japanese yen for reference.
Let me ask you why you don't think they're going to be able to patch things together this time, because obviously Mario Draghi led the charge last time when he was at the ECB, and we'll do whatever it takes argument actually frightened the market sufficiently that we didn't see a blowout in spreads between the Bund and the BTP beyond what was perceived to be manageable. Now we've got this threat of a new tool that is not the ESM, it is not the OMT, it's going to be something different. And that did have some psychological effect, very short term, on the market's view on where spreads could go. But why do you think the ECB can't hold things together this time round?
Well, I think it's a little bit, Jeff, it's a little bit like fool me once, fool me twice. There wasn't really a huge amount of substance behind the last attempts by Mario Draghi. A lot of it was simply hot air. Admittedly, the COVID-19 crisis has allowed the ECB to pump in huge amounts of money, and that has basically temporarily stopped fragmentation. Now you're seeing those programs basically run off. You've got a serious situation with inflation in the Eurozone. The northern economies are very anti-inflationary, as we know. Are they going to tolerate the ECB printing yet more money? And the question is, there is a dilemma you've got to face. You either have lower inflation or you avoid fragmentation. You print money to avoid fragmentation. They'll have to move towards, if they are going to avoid fragmentation, they'll have to move towards some sort of notional yield curve control. Look what happened in Japan, or what is happening in Japan before our eyes with a yield curve control. They're sacrificing the Japanese yen. The Japanese yen has basically devalued from early March to early May at a phenomenal over 80% annualized rate. This is just eye-watering collapse. If the Eurozone sees a similar devaluation, we're not going to be below parity, we're going to be below 90 cents. These are serious drops. Already, if you look at the Japanese yen, it's devalued so much that it's looking about 20% cheap against the euro as we stand now.